So yesterday RBI did the rate cuts. So what are challenges of the rate cuts? So RBI has cut interest rates again, borrowing becomes cheaper, and growth gets a boost. But every rate cut comes with hidden risks. From a weaker rupee to hurting your fixed deposit, RBI is now walking a very fine line. In December 2025, the RBI cut the repo rate by 25 basis points to 5.25%. This is the fourth cut this year. Inflation is low and growth is strong. So, what is the problem? Today, we break down the biggest challenges India faces because of these rate cuts in simple language. So, risk of reigniting inflation. Inflation risk return. What is? So right now inflation is low around 2%, but India's economy is growing fast 8.2% in quarter 2 FY26. Cutting rates in a high growth phase is risky. It increases borrowing, increases spending, increases demand. If prices rise or global commodity price jump, inflation can shoot right back up. So RBI's biggest challenge is how to support growth without accidentally creating future inflation. The second one is a weaker rupee and capital outflows. Rupee under pressure. This one is serious. The rupee fell below 90 rupee per dollar in 2025, its weakest level ever. When RBI cuts rate and the US keeps rates high, foreign investors prefer America. Money flows out of India, rupee get weaker. A weaker rupee makes import costlier, especially oil. Costly imports which is equal to higher inflation again. So rate cuts can trap RBI in a cycle of rate cuts, rupee fall, inflation rises, RBI loses flexibility. The third one is poor transmission to the real economy. Bank wouldn't pass it on. So here is the strange part, even after 125 basis points of rate cuts this year, lending rates haven't fallen enough. Banks are cautious, demand for loan is uneven, fresh rupee loans are actually becoming costlier in some cases. If rate cuts don't translate into cheaper loans, businesses and custom and consumers don't benefit. This weakens the entire purpose of cutting rates. Next is households suffer falling FD rates. Bad news for savers. Borrowers like rate cuts, but savers not so much. Banks already lowered FD rates by 50 to 100 basis points in 2025. For example, HDFC Bank peak FD went from 7.25% to 6.6%. Retirees and middle class savers depend on interest income. Lower returns reduce their consumption and push them toward risky investments. So RBI has to balance. Should growth come at the cost of household savings? Next is global uncertainty. Next is global uncertainty makes things worse. External shocks. The world economy is not stable right now. US tariffs, geopolitical tensions, slowdowns in Europe and China, everything affects India. Rate cuts help liquidity in the short term, but they don't protect India. If exports fall, crude oil prices rise, the current account deficit widens, the RBI is doing forex swap and OMOs, but the global environment is still unpredictable. Small businesses still not benefiting, with MSME left out. Small businesses borrow at 10 to 12% interest or 25 basis point cut barely matters for them. Demand issues, high working capital needs, and expensive credit continue. Plus, FII's outflows affect rate-sensitive sectors like real estate and auto. So the benefit of rate cuts is not evenly distributed across the economy. So what is the conclusion? So yes, RBI is cutting rates to support growth, but every cut carries risks, inflation, a weaker rupee, pressure on savings, and limited transmission. The Indian economy is in a Goldilocks moment, low inflation, strong growth, but it is also a fragile moment. How RBI balances growth, currency stability, and inflation in 2026 will decide India's economic direction. So like the video. If this helped you understand the issue, comment below. Do you think RBI should continue cutting rates or pause now? And don't forget to subscribe for more simple economic explainers. Thank you.